Now I'd like to introduce Jeff Waldeck, Christine, and Mark Salvaggio to start today's webinar.
Thanks, Andrea, and welcome everybody. Good afternoon. Welcome to our last session, I think, of our tax GBQ quarterly series, the year-end business tax update. My name is Chris Dean. I'm a partner in our tax group. Here in Columbus, I'm joined by two of my colleagues, Jeff Waldeck, who is a partner in our specialty tax services group, and Mark Salvaggio, a director in our corporate tax group. We got a great agenda for you today. We're going to take about an hour, walk you through some business provisions here. We hope you find these materials useful. We've got some good information, and we've put in some numeric examples to kind of illustrate some of the points we're going to be talking about today. So without further ado, let's get into it. So the agenda for today, if you want to advance that slide. So mostly we're going to be talking about the OBBBA and identify some opportunities for your business. This is most of what folks have been talking about since July when it was passed. Like I said, we're going to be giving you some numeric examples and talking about some planning strategies and some things to maybe be thinking about through the lens of some of these provisions in the bill. We're going to give you some status updates on some tax credits that are out there, and then we'll end with some international tax provisions that need to be aware of. At the end, we've added a couple slides if we have time to talk about how to maybe monetize some of these benefits that we're talking about with some tax forms, and then we also like to throw in a kind of a state of the IRS slide just to give you guys some sense of where we sit today, how things are going from an administrative standpoint. So with that being said, I'm going to go ahead and turn it over to Jeff Waldeck. But first, we're going to hit that first CPE word. For those of you who need CPE credit, there it is, tax. We'll let that hang there for a second. And once you guys are ready to advance this slide, Jeff, I'll turn it over to you.
All right, thanks, Chris. And give people a few seconds here to get the code word in so you can get your CPE credit. All right, so we'll go ahead and advance. So I'm going to start us off by talking about some of the key business tax changes that resulted from OB3. So if you go to the next slide. So the first three that I'm going to focus on really relate to R&D capitalization, interest expense deductibility, and then bonus depreciation. When we look at OB3 for businesses, these three items seem to have a pretty widespread impact on a lot of businesses, and you're going to want to pay attention to and really model out what it means for your business. So starting with R&D changes, we can go to the next slide. To understand what really happened with R&D, you really kind of need to understand the historical context. So since really the beginning of time in R&D through 2022, you really didn't have to worry about what was an R&D cost, what was a Section 174 cost. What you did as a taxpayer is you were able to deduct those costs as incurred, whether or not they're domestic or foreign. And so it was a good road. And starting in the 80s, you could start taking advantage of an R&D tax credit. So for a lot of companies out there that did research and development expenses, the result was they get a deduction for those expenses each year, and then they get a 5 to 10% credit on top of that to lower their tax bill. So prior to 2022, R&D was always a great space to be in for companies. One is because it helps really improve or change your business in a beneficial manner, but then two, you're getting tax advantages out of it. Then things changed starting in 2022. So we go to the next slide. So part of the TCJA bill, there was a revenue raiser in that bill that many people thought would never see the light of day. But it did. It did. And so from 2022 to 2024, the rules changed with 174 costs in that you had to start capitalizing and amortizing your domestic costs over a 5-year period. And for foreign R&D, you had to capitalize and amortize over a 15-year period. You could still claim an R&D credit, so you still got a rebate out of these costs. But this was a big change for companies. And just thinking about it practically, if you're if you're paying, your software developer $100,000 as your business to develop new apps for your company, historically you'd get $100,000 deduction plus probably a $5,000 to $10,000 tax credit based on that expense. In 2022, all of a sudden, you only got a $10,000 tax deduction for the $100,000 you're paying the software developer. So it was a material change. It was a big tax add back for 3 years for companies, where if you're looking at it from a GAAP book income basis, companies were paying upwards, depending on their R&D. I mean, we saw some scenarios where companies were paying 60 to 70% effective tax rate if they're heavily involved in R&D compared to their GAAP income. So it's a big tax add back for those 2 years. So then we fast forward to now. So what did this bill do to that capitalization rule? So if we go to the next slide, OB3 restores the immediate deductions of domestic R&D costs. So we get back to the pre-rules of 22 and before 2022, and are able to take those deductions immediately, get back to how people expect it. Still can take a tax credit for your domestic R&D. However, there is still the amortization for foreign costs. So if you have foreign costs, it's a 15-year amortization period. So it's a pretty heavy penalty on having foreign R&D. Not only can you not get R&D tax credits for foreign R&D here in the States, you have to add back those costs and amortize over 15 years. So it's really kind of caused companies to look at, hey, if I'm paying a developer overseas or in another country, is it really cheaper for me to do that? Because I don't get this tax credit, and I really don't get a deduction or your deductions spread over a long period of time, or you really don't get to see it for a long time. So that's where we are today. But now it kind of has people wondering, okay, so what do I do with those costs from 22 to 2024? And so we have a few different options that came out of this bill. So one option is you can take any of those unamortized domestic costs and you can deduct them right away in 2025. That could be a great answer for some taxpayers. Some people might say I don't need that many deductions. That's a lot of deductions if I've been heavily utilizing R&D. So they create a second option which says you can evenly spread it over 25 and 26. So again, that might take some modeling for some companies to figure out what's the best answer for me. And the third option is you can actually continue to amortize over 5 years. So we saw a lot of startup companies where this really didn't impact them. This new rule really didn't impact them in a negative manner at all. They might be in a situation, if you're kind of a pre-revenue state or your taxable income state, maybe amortizing isn't a bad idea and doing it over 5 years. So it gives you those kind of options to play with. Do want to talk about one other option that's not on your screen. If you are a qualified small business, so that's 31 million of average receipts and not a tax shelter, there is a fourth option, and that's going back and amending your 22 through 24 tax returns and taking deductions for each year. There's a lot of caveats with that. You have to amend each of those tax returns. So if you can't pick and choose years of which ones you want to do, you'd have to amend 22, 23, and 24. And you got to look at how the impact of R&D interplays with other aspects of the tax law. So again, modeling is necessary before you really dive in and make a decision on this. We'll flip to the next slide. I want to give kind of a practical example, just really looking at this R&D rule. And so in this example, we're looking at a C corporation that has, yearly R&D costs, 174 costs of $1 million. These are all domestic costs. In this example, we're going to say that the company has taxable income in 2025 of $4 million prior to looking at their 174 deductions. And so the question is, what do we do? And so first, let's see what they did historically. So we kind of gave that math example in 2022. You're only getting a 10% deduction on those costs. So they were hit pretty hard, about $139,000 of additional tax based on the 2022 rule change. You can see how that kind of phased out a little bit by 2024. But now we're sitting with a large amount of unamortized R&D costs. We got $2.1 million sitting there in unamortized R&D. The question is, what do we do with it? In this example, it's fairly straightforward. If we have $4 million of taxable income and we have $2.1 million of unamortized costs plus $1 million this year, we might as well go ahead and take the whole thing, bring us down to $900,000 of taxable income. We'll get about a $50,000 tax credit. We're going to get almost $500,000 of tax savings by making this application for this year. So here, not a ton of modeling needs to be done. Pretty good result for the taxpayer. But if that taxable income shifted to, say, $2 million, then you have something to think about, because then all of a sudden a $3.1 million deduction shifts you into a loss. And the question is, can I use the loss? Can I go back a year to take R&D credits in a carryback manner? So then that's when modeling really becomes critical. Do I really need to take this all in 2025, or should I ratably spread it between 2 years and get to a pretty good tax answer by spreading it to 2 years? So facts and circumstances are going to matter. There's really not a one size fits all when you're looking at modeling out your R&D. We can go to the next slide. These next couple, we're really looking to just kind of show some math. If you've been part of our presentations on math, or in the past, you've seen that we've kind of gotten into the weeds on the rules. We really want to show, okay, what's the applicability for a lot of companies? And so this model is going to focus in on the interest expense limitation of 163J and bonus depreciation. So when we're looking at interest expense, the key change again in 2022 was there's a limit on your interest deductibility of 30% of your taxable EBIT income. So from 2022 through 2024, a lot of companies were subject to limitations on what they could deduct in their interest. What OB3 did is it returned the calculation to an EBITDA calculation. So you still have to look at it. You still have to see, am I going to be limited by this 30%? But at least you can add back your depreciation and your amortization. When you couple that with a bonus depreciation now being restored to 100%, this can have a real material impact of how much you can deduct in interest and what your taxable income is going to look like. So bonus depreciation was scheduled to go down to 40% going into this year, and we are back up to 100% permanently for assets in service after January 19th. So this example kind of gives some practicality of what that looks like. So if we're looking at a taxpayer with $6 million of pre-tax EBITDA income, what did that look like pre-OB3 versus post-OB3? So in this scenario, we're assuming $3 million of additions, and we're assuming $2 million of interest expense. We're not saying you can deduct it yet, but that's what the expense is. So the first thing you'll notice right away is tax depreciation. You're getting a much larger tax depreciation deduction in the post-OB3 area. You're getting the full $3 million write-off on those additions, where you're much limited in the pre-OB3 era. You're still getting the same tax amortization you would have on both sides, but it does have an impact on your 163J calculation. So when you're looking at your adjusted taxable income for the purposes of your interest deduction, going down to the third line down, you're still at $6 million on the interest calculation that you can look at. So in the post OB3, you start with $6 million. You're limited to 30%. So you got $1.8 million is allowable interest deduction of the $2 million that you have out there. In the pre-OB3, you're limited because you can't have that depreciation or amortization. So you're looking at only being able to deduct 1.1 million. So there's a big shift in what you can deduct pre-OB3, post-OB3. So when you put that all into play and look at in the middle there of your taxable income, even though you have very similar facts, you have one scenario where you have 2.665 of taxable income and the post OB3 of a $50,000 loss, resulting in no tax liability post OB3 and a pretty significant tax liability pre. So just these two items put together, you can see this is a big deal for a lot of companies. If you're heavily investing in equipment, it's certainly incentivizing equipment investment. It's also looking at, okay, we might be in a better situation if you are taking on bank debt to fund some of these additions. So we can get to the next slide here. The last slide, we wanted to put together an example that really put all of these items in motion. As you can see here, there's a lot going on with this example, but the key thing we're trying to show you is you really got to pick up the phone this year to talk to your tax advisor and say, hey, how have things changed from last year? How is this going to impact me? So just keep that in mind as we're going through this interplay. But in this example, let's assume pre-tax EBITDA income of $10 million. Let's say the company had 5.5 million of additions. You had 174, so you had R&D capitalization, so current year 1.5 million. Your prior 3 years of 3.5 you capitalized, so you've been amortizing that along the way, and you have interest expense as well. So how is that all going to interplay? So first of all, looking right at the depreciation deduction, you can see with bonus depreciation, pretty significant impact. You're going to be able to deduct a lot more. You're getting 100% write-off on the PPE versus you're much limited in your depreciation deduction. When you're looking at capitalization, in the prior pre-OB3, you had been capitalizing all of your 174. Here, you can immediately expense it. So you're going to find that in the amortization 174. We're also able to take all of our costs from the prior year and deduct them right away. So there's 22 to 24, we're taking all 3.5 million. Had we just continued to run out amortization, we would have only gotten 850,000. So just in those two examples there, we're coming up with some significant differences in what taxable income is going to look like. If we roll that down to our adjusted TI and look at what's available for interest deduction, we have a much better situation for interest as well. Even though we're getting these big depreciation deductions, we're getting this amortization of 174, when we're looking at the 163J calculation, we're able to add that all back, which gives us a much better ability to deduct our interest. So when we get to the middle there and look at our taxable income, it's a massive difference, about $8.8 million shift in taxable income for this company, even though they're doing the exact same thing. So that's a tax liability of 1.1 million pre-OB3, zero after. So again, big shifts, big things to look at here to see how it's going to impact companies.
Yeah, and Jeff, just to jump in as well, calling back to the history of 174, and everybody was convinced back in 2022, 2023, hey, this thing's never going to go into effect. And so, I had a lot of clients that didn't want to make those estimated payments of tax just because they were being told on all fronts, hey, this is not going to be the rules when you file your tax return. So why should you pay out your cash? Well, it turned out that that wasn't the case, right? And so unfortunately, some clients, had interest and penalties associated with that. So this time around, we mentioned this was passed in July. So this time around, we had Q1 and Q2 tax payments due already before this was passed. So if you look at that pre-OBBBA column, you might have $500,000 of tax paid in already under the old rules. And now, you're looking at your projections and you're saying, okay, well, I've got nothing. So a little later, we're going to go through, what to do in that scenario. If you do have cash paid in already, and also, Jeff, the work you do around R&D credits, right? Even with that $0 tax liability, it might make sense to still do the study for the year. Make sure you're filing that, and there's different ways you can capture that benefit.
Yeah, absolutely. On the R&D angle, I mean, not only, do credits carry forward, but you actually have a carry back. You have a 1-year carry back you can look at. So there, again, it's added to the modeling that needs to be done of what makes the most sense for the company. But still generating R&D credits is going to be important for 25 and beyond. But we can go to the next slide here.
Hey, Jeff, before you do that, I think this is a good context of why we thought like a numeric example would be good, because these aren't the only tax planning ideas that folks have, right? There's the standard kind of defer income, accelerate deductions are still in play, method changes. Some of those things are in there. I think what most people are going to have to decide is what happens once you hit zero. So once the liability is gone, in a C Corp context, you're talking about a net operating loss that can no longer be carried back, but forward. So do other tax planning strategies that are just going to give you a bigger NOL really get you much benefit? Probably not currently, but how does that factor into maybe 26, 27 and beyond? If you're a pass-through, business income limitations at that level, that is kind of an analysis that takes it from the business down to the individual shareholders or partners, and kind of looking at that kind of stuff. So context is everything. We kind of are, I guess, preaching sort of a holistic approach here. But these items, because they're new, might not be on everybody's radar as they're doing other considerations for tax planning. So what we're stressing is to maybe incorporate these into overall what you're looking at. And, the math's important on this one. So this would be of all years, the year to pay attention, as we come get to the end of December here. So.
Yeah, absolutely. A lot of good things here, a lot of areas that give businesses ways to plan, but do want to talk about some things that are going away related to OB3. That's some of the status of your green energy tax credits. So the first one on the list, commercial clean vehicle credit. So that has expired. So that one's expired. It was scheduled for 2032. They accelerated that to September 30th of 2025. The next one's going to be your Section 179D. So this does have broad applicability, particularly if you're doing expansion projects. So for this one, construction must begin by June 30th of 2026. So again, if you've been someone who's utilized 179D in the past, or you have a project that might be applicable to this is a reason to kind of pick up the phone, start thinking about getting this thing on the move quickly, and making sure that you're actually going to be able to get the benefit that you think you might with 179D. The next two, so clean hydrogen, so that again is moved up to construction must commence before December 31st, 27. And then your solar and wind credits, those must start by July 4th of 2026. It must be in service by December 31st, 2027. So again, there's some new rules around here that you're going to have to look at as far as timing. If you're planning to do any of these types of projects, it's things you need to really push to the front burner and talk to your tax advisor to really get a good feel for, am I actually going to utilize this benefit that I thought I was going to get with these credits. You can skip on to the next one here. And so we have our second CPE code word. So our word's going to be planning. So planning, make sure you get that one down. We'll give you a few seconds here to get those in. All right, so we can get to the next slide, and did want to talk about, we talked a little bit about bonus depreciation, how 100% deductions is a big deal for a lot of businesses. Within that, there is a new category of property that was created. It's called qualified production property. And so that's going to allow immediate expensing for qualified production-related non-residential property placed in service after January 19th of 2025. This is really looking at your manufacturers and looking at, are you expanding manufacturing space that is increasing production of the business? And there are still some regulations that we're waiting on to come out on this. So there's still some stipulations that we're going to have to kind of go through to figure out what exactly is a qualified production property. But the general takeaway is, if you are doing, you have any of these projects in mind, or you got them started here in 2025, this is going to be a big deal. This is taking property that has historically been 39-year depreciable property, so you're getting about a 2 to 3% rate of depreciation on what you invested in it each year, to now all of a sudden getting 100% write-off on qualified property. So this is it could be a massive advantage for those expanding their manufacturing space. There are exclusions on this, so property must be integral to production. Office space, administrative space, any of that's not going to be included in this. And this is kind of why it's vital that if you're going to take advantage of this, you really need a cost segregation study to be able to defend, here's what is my qualified production space, and that you are, accurately breaking out what items don't qualify. You expect that if you have one of these investments, you probably don't have 100% of that investment that's going to qualify for QPP. So that's where a cost seg is able to break it down, give you something that's defendable if the IRS comes knocking related to this type of property. But it is a big deal. I mean, taking, if you have a $2 million expansion to your manufacturing space, and you can get, let's say 90% of that qualifies towards a QPP, that's accelerating a large amount of deductions into the year, and getting a big write-off for the company. So definitely another planning tool to look at as you're looking at what I'm doing. Something that historically you're not getting these large deductions for, you might this year. So you want to start looking at this for both 25 and going forward. I can hand it over now to Mark. He's going to get into charitable deductions.
Thanks, Jeff. All right, so charitable contributions, we've got some new limitations. Everything that Jeff just went over, for the most part, is effective for 2025. So that gets into the point we were talking about earlier about having maybe made some estimated payments based on the old rules. Now you got the new rules coming in. These rules around charitable contributions are going to be for 26 and forward. So we still have a few weeks left in the year 2025 under the old rules, and so I'd say the takeaway from this is that these rules they're not friendly towards charitable contributions. So to the extent you've got the cash and the desire and the charitable goals, and you're able to accelerate it into 2025, generally that's a good idea. Definitely something to consider, in conjunction with your tax advisor. So, no, we had the update on the individual side a couple of days ago, but still wanted to pop this one in here. There is a new adjusted gross income, or AGI, floor for itemizers. So if you itemize your deductions, you are, if you're taking advantage of the higher state and local tax cap that's now in place, if you are itemizing your deductions, you are subject to a 0.5% AGI floor. So that can kind of reduce some benefits on the smaller donations, which we'll see in a second. Also, if you're a high income taxpayer, the marginal tax benefit, so the percentage tax benefit that you get for each extra deduction, is going to be capped at 35%. And so that's a little bit complicated, but generally, if you're in the 37% tax bracket, you've got your deductions. They're going to reduce your income at a tax rate of 37%. If you're itemizing in years after 2025, then that benefit is actually going to be capped at 35%. So a little extra complexity there, but again, not taxpayer favorable. This next one, above the line deduction for non-itemizers. So if you do not have enough itemized deductions for it to make sense for you to itemize, then you still can get the benefit of charitable contributions. You are capped at $1,000 if you're filing single, and $2,000 if you're married filing jointly. So that is taxpayer favorable. Generally, it gives you some flexibility in how you deduct your charitable contributions. The corporate deduction has also undergone a shift, and really it's difficult to explain without showing an example. But I'll just give the quick definition here that corporations now have a 1% floor and a 10% ceiling on deductions. So that sweet spot between 1% and 10%, that's where you can deduct, and then carry forward for excess contributions. So again, we'll get into it in a couple of slides, but basically, if you are below the 10% ceiling, then you do not get any benefit from that floor. If you are above the 10% ceiling, you can carry forward both what's above the ceiling and what's below the floor. So definitely plenty complicated. So we'll get into some examples to kind of make this real. So in this example, got the pre and post OBBA here. You've got adjusted gross income of $750,000. You've got charitable contributions of $5,000. Okay, so pre-OBBA, you've got a zero, there is no AGI floor. Post-OBBA, you've got a 0.5% AGI floor. That means that whereas under the old rules, currently in effect in 25, you do not have any non-deductible charitable contributions. So you can deduct that entire $5,000 if you're itemizing. Post-OBBA, you have that floor of $3,750. And so what that, as you can see, does is that reduces the amount that you can deduct from $5,000 to $1,250. So a meaningful reduction for those smaller sort of donations, especially as you climb the income ladder and that adjusted gross income floor increases.
Yeah. Hey, Mark, just to interject on that, and also to add to this, what you had on the previous slide, once you get into those higher income earners, you're also taking a haircut on your overall itemized deductions. So a lot of the conversations we're having around our clients is like, hey, 2025 is the year where you're going to get probably the most bang for your buck. I think most people can agree that that's probably what's going to happen. If you have charitable intent, like Mark was saying, most folks have heard of the concept of a donor advised fund where maybe you want to make the contribution in 25, but don't yet know where it's all going to be deployed in a future year. That can be a powerful way to make sure you get the charitable contribution in 25. Also, this is a kind of a tried and true, instead of cash, donate an appreciated, capital gain property like publicly traded stock has always been a popular way to do it for twofold. You get to exclude the gain and you get the charitable contribution based on the fair market value, subject to a couple of limitations. Market's been at a pretty high place. If you got some stock that you think you're topped out on and you don't want to sell it because it's sitting on a big unrealized gain that you would have to pay tax on, and you were planning on giving a charitable contribution anyway, this might be a way to navigate doing something there that makes a lot of tax sense as well.
Thank you, Chris. So then moving on to the corporate rules. So I kind of warned you guys that this was going to be a little bit more complex. So bear with me for a few minutes here. We'll kind of go through and navigate these rules. So you got pre-OBBA on the left, post-OBBA on the right, and spread over 2 years, so you can kind of see how these carry forwards work. So in all the years, we've got taxable income without taking charitable contributions into account of $1 million. Charitable contributions of, in year one, got 110,000. And so then that gives us a ceiling of $100,000, and that's based on 10% of the taxable income. Pre-OBBA, there's no taxable floor, so that's not applicable. So your permitted deduction here is going to be $100,000 in year one. So far, so good. We have a carry forward of $10,000, and that can carry forward up to 5 years. So we move on to year two, again, under the old rules, and still have $1 million of income. The charitable contributions, didn't make any new ones, but we picked up that carry forward from year one. So we have that $10,000 carry forward and still have a ceiling of 10%, no taxable income floor. So then that allows us to deduct that $10,000 carry forward, and we have no carry forward after year two. So year one, you made the contribution of 110,000, and your total deduction over 2 years is 110,000. So move over to the new rules here. So still have $1 million of taxable income pre contributions. Still made the $110,000 charitable contribution in year one. Still have that taxable ceiling of 10%, but now we have a taxable income floor of 1%. And so that floor of $10,000 is going to kind of cut us off at the legs there, and we can only deduct in year one the amount between the 10,000 and the 100,000. So that gives us a $90,000 deduction in year one. And because, and this is an important point here, because our contributions for the year were 110,000 over, that was over the ceiling of 100,000, we are allowed to carry forward both the amount that was disallowed under the ceiling, so 10,000, and the amount that was disallowed under the floor, so another 10,000. So we move over to year two. Again, we've got $1 million of taxable income pre-charitables. We don't make any new contributions, so we've got the $20,000 carry forward from the prior year. Taxable income ceiling is going to be $100,000, 10% of the million. Taxable income floor, again, is going to be $10,000. Now, this year, our charitable contributions are $20,000, so we did not exceed that taxable income ceiling. And so we can't carry forward anything that was under that floor. So we had carry forwards of 20,000. Our floor tells us we got, our floor is 10,000. So our permitted deduction is going to be 10,000 and no carry forward. So if you look at the kind of bottom line there, unlike the old rules, in the new rules, when you make a $110,000 charitable contribution as a corporation, over 2 years in this scenario, you're not getting $110,000 of deduction, you're getting $100,000 of deduction. So again, I think when you heard those rules on that first slide with just the words, it's hard to kind of piece that together, but this is what the rules are doing, and this is kind of why it's there, right? It's there as a revenue raiser. So definitely something to keep in mind. As we've said, got a few weeks left under the old rules. If you're able to make some contributions before the new year, it may be of benefit to do so. All right, so the next CPE code word is here, and that word is asset. So let's go for 100% correct responses on this one, everybody. All right. I think we hit that 100%. So well done, everybody. So now, as if that wasn't complicated enough, for those of you who stuck with us, we've got some international tax updates, and this stuff can also get fairly complicated. So, we're not going to dive too deeply into the weeds here, but we do have a couple examples that demonstrate, how these rules operate and what to watch out for, who might be affected by the change in these rules. So we really wanted to just focus on the most broadly applicable changes to our client base, certainly, and the businesses that we typically advise. If you do have any questions on international updates that we are not discussing here, there are quite a few. And if you do have questions on those, do feel free to reach out separately from the presentation, or even in the chat. We can kind of address those if there's some interest. So the first one here is changes to FDII and GILTI. And the initial changes, they're not called FDII and GILTI anymore, or FDII and GILTI. They're now called FDDEI and NCTI, or NICTI. So on the FDII or FDE side, the deduction has been reduced to 33.34%, which essentially raises the effective tax rate, but the calculations here have been significantly simplified, and also as a result expanded to potential new taxpayers. So we'll see that in a second in the example. GILTI is now NICTI or NCTI, net CFC tested income. The deduction has been lowered to 40%, which increases the US tax rate, and the qualified business asset income has been taken out of GILTI. And the foreign tax credit changes, the haircut has decreased to 10%, which, or I'm sorry, it should say increased to 90%. Old rules were, it was 80%, new rules are it's 90%. And that is, again, we'll see it kind of in the example, but just a little flavor of what these rules have the changes that these rules have made. So for FDDEI or FDE, just giving out the facts here that we'll see in the chart in a second. Assume that US Co generates foreign-derived deductible income of $100, which is essentially your foreign gross sales minus your cost of goods sold on those sales. US Co has $100 of R&D expense and interest expense, and they're properly allocable to the foreign income, and $2,000 of QBuy. And QBuy in this context is essentially your PP&E. So in this example, we're going to assume for expense allocation purposes that asset values used to produce your domestic and your foreign income are generally in the same proportion as your income that you actually earn, which basically stands to reason. And then also, this is another key point, which gets into our planning and our modeling that we've been hammering this whole time. Assume that the corporation has sufficient taxable income to benefit from this entire deduction, which is called the Section 250 deduction. So you do need taxable income in order to benefit from this. You cannot use this to generate or increase a loss. Okay, so a lot of numbers here. Before I go through all the numbers, I'll just kind of hone in on the bottom line here. So pre-OBBA, under these facts, your tax rate benefit on foreign derived income would have been 0%. Post-OBBA, now it's 7%. So you're effectively, as a C Corp, you're taking this from 21% to a 14% effective tax rate. on your foreign income. So that's why we wanted to kind of go through this. That's why we wanted to include these rules, is because maybe you technically had some of this income in the past, but it wasn't really applicable to you because you had a good amount of PP&E, and that under the old rules you just couldn't capture this deduction. So, start at the top. We've got gross DEI, that's kind of gross income, gross FDDEI, which is your foreign income. You're allocating your expenses 33% to foreign derived income. And remember, we said we've got R&D and interest of $100. So under the old rules, we would allocate $33 of expense to the foreign derived income. Your net deductible income is going to be 200, which is 300 less that 100 of R&D and interest. But then your net foreign income is going to be your foreign income less that $33 that we calculated above. Also, under the old rules, you had PP&E of $2,000. The rules said that you needed to deduct 10% of that from this potential deduction. And so you had $67 of foreign income. You had to take off that $200. That leaves you with $0 of foreign derived intangible income under the old rules. It doesn't matter what the deduction percentage was because you didn't have a deduction. So, kind of zeros all the way down pre-OBBA. We shift to the other side and we see that, what are the differences here? Well, we're not reducing that foreign income by R&D and interest anymore. The new rules say that that is 100% allocated against your domestic income, which in this context is a good thing. Also, QBI, there is no sort of reduction to this deduction for a deemed return on your PP&E. So again, you look at the rules on the right side, you're left with foreign income of $100. And then you take your deduction percentage, which has been reduced from 37.5 to 33%. And you've got a deduction of $33, and that's your Section 250 deduction. So again, if you've otherwise got sufficient taxable income, that is going to give you a tax benefit of $7. So again, wanted to include this. Don't expect everybody to be an expert after this, but wanted to include it because it does really demonstrate that this change in the rules without a change in facts produces a meaningful result. You add a few zeros to the end of all these numbers. So we were getting a little close on time. We want to make sure we do have enough time for any questions as well as some practical applications. But this is the old GILTI, now the new NICTI. I'm not going to read through these kind of facts on this one. But we go over to the pre and post OBBA, even more complicated than the FDDEI example that we just went through. But you look at the bottom line here, and your taxes have gone up, right? Your incremental tax in this example has gone from $1 up to $3.40. And a lot of that is because you had up towards the top QBI, you had PP&E that was located outside of the U.S. Under the old rules, that was sort of shielding you from this tax liability. Under the new rules, they, if not penalize, they don't want to incentivize holding fixed assets outside of the U.S. So these slides will be available for folks to download and peruse at their leisure. But again, wanted to just raise this up. This is a change that has happened, and even barring any change in facts, your taxes on this income will almost certainly change. So with all that, I wanted to turn it over then to Chris, who is going to talk a little bit about practical applications and some of the state of play at the IRS.
Yeah, thanks, Mark. Yeah, to kind of bring us home here. So a lot of these numeric examples, we're throwing out dollars, and especially with some of the stuff Jeff put out there, there's this concept of, okay, it sounds like I'm getting a tax benefit. What's the best way to monetize that? And so a couple of things, this enactment happened early in July of this year. So one of the easiest ways to save money is to curtail your third and fourth quarter estimates. If you're doing, and a lot of people are doing that now, you're recalculating the math and calibrating it to the actual rules that are going to be in place for 2025. And to the extent you've overshot in your first Q, the easiest way to get your money is to keep your money and adjusting your estimates on that. But beyond that, there's also a couple of forms that I think are probably going to be coming into play that most people don't think a lot about. So if we can go to the next slide, I just wanted to throw a couple of these up here and give you a sense. The top one and the bottom one, practitioners probably have some familiarity with. Those are the tentative refund. Those were used. The 1045 is for individuals. The 1139 is for corps. Those were typically used in the context of carrying back net operating losses. Net operating losses no longer get carried backwards after a certain date. So everything goes forward, but the form still exists. And the form still exists because there's still carrybacks that happen for general business credits, like the R&D credit, and also capital loss carrybacks for corps. And so what these forms essentially allow you to do is file a claim for a refund without filing an amended return to kind of claim, there's a timeline. They typically get processed faster, and you have to file them within a certain time frame after the year end of the benefits. But to the extent in Jeff's example where we wiped out taxable income, so there was no tax, but you're still generating an R&D credit, your ability to carry back 1 year, presuming you have sufficient tax liability to claim that, could be done on one of these forms. And this form gets filed within 1 year of the year that the claim is generated. So if it's a 25 R&D credit, when you file your return in 26, if you file one of these forms by 12/31 of 26, they're supposed to be processed within 60 days, and it's a way to get some money back sooner rather than later. So pay attention to those. Look at those again. One's for individuals, one's for corps. There's some attachments, and there's a process for which that's well established of how you file these. And they've been pretty successful. Even throughout COVID, these ones tend to get processed in a meaningful way. That we think is a good way to not have to do a whole amending process and to maybe get some dollars back that you're entitled to. The middle form there is for C Corps, the 4466, and this form is really for people that greatly overshoot on their estimates. So perhaps even going to zero for Q3 and Q4, you're still overpaid by what you paid in Q1 and Q2. What are your options? Well, a corporation, a C corporation that basically has an overpayment, anticipated overpayment that is in excess of 10% of their liability, they can essentially file one of these for a quick refund to get back some of those estimates, even if before you file your tax return. And the timing on this is important. It has to be done after the year end. So if you're a calendar year taxpayer, it has to be after 12/31 of 25, and you have to do it before your original due date of your return of April 15th. So if you're going to do this, the feeling would be, hey, as soon as the calendar turns from December to January, this is the one that you probably want to get in to try to get some of that money back, especially big corporate taxpayers who may not be ultimately filing their 25 tax return, maybe even until October of 26. So you can speed up by a magnitude of 10 months potentially if you're able to do this. So pay attention. This form's been around. All these forms have been around for a lot. We just think this is a year where a lot of fact patterns are probably going to line up that one of these or a couple of these might be applicable, and wanted to put them back on folks' radar. So with that, I think we can go to our last slide. So we like to put this up. We kind of, like I said at the beginning of the presentation, like to give you kind of a state of the IRS. I don't think anybody's going to be shocked by these. If you even follow the news lightly, you probably are hearing things like this, that there's a lot of disruption inside the IRS. 7 at a time, 9 top officials are acting or vacant, 9 at 29, and the large business and international division roles are either acting. So there's a lot of people that might be in either temporary or transitory type positions. There might be some vacant positions that have not been filled yet, and staffing is an overall kind of problem or issue that the IRS is facing. There's been some funding in the past to up it. Those have been, there's a lot going on to where it's got people asking like, okay, what does that mean for me? And, some of the questions that might come up is, how do you get examinations or notices, appeals, litigation? If you are in the process of doing something that has a normal channel through the IRS, will the timing be affected by some of this? That's a very distinct probability. I think that should factor into some of these decisions that we're talking about amending prior returns and doing some things, trying to get things resolved with the IRS just seems to take longer anecdotally. And the numbers of what's going on with their staffing, tend to support that. If you have guidance coming out too, they've also been tasked whenever there's a big chunk of new legislation like we had in July, we've been talking about all session here. The people that put out the guidance are the same people that examine you on the guide on your return. So they have their hands full trying to put out some guidance. It's coming in dribs and drabs. We expect more to come as we get into 26. But the timing of those might be affected by some of the staffing issues and things going on inside the IRS as well. So again, I don't think anybody's shocked by this. I just put that here to give some folks some context of the kinds of things that they might consider. Okay, where are we in the process? Where can we maybe do better by filing a form rather than making calls or doing POA? Like all that kind of stuff should be considered when you're looking at an issue and you're dealing with a tax authority as large as the IRS. So with that, I guess Jeff or Mark, if you have anything to add on this, while we're flashing that last CPE code word, and if there's any questions or anything that came in, I'll kind of open up the floor to that after we do this last question.
Yeah, I would say just the one, and I mentioned it, the QPP is a qualified production property. Like when you mentioned guidance, I think in a historical context, when we didn't have government shutdowns and we didn't have the IRS kind of, these reduced roles that they have, we might have seen guidance by now, but we don't have guidance. And when there is some like real question marks as, what's considered manufacturing property, that will be something that's key when we're looking at these. If you have a project for 2025, or it might delay our ability to to get the tax return done because we want to wait for that guidance, or if the guidance isn't out, we might have to make decisions on tax positions that might not be as clear. So just certain things to think about, particularly when we're waiting on guidance on those sorts of things. I would say that's probably the one in my mind that is going to come up.
Yeah. Good point.
There was one question from the audience. I did answer it in the chat, but just for anybody else who may have been wondering, the new rule for charitable deductions for non-itemizers, that starts in 2026.